Welcome back to the Deep Dive. Today, you've handed me this really fascinating set of documents. It details what I can only call the ultimate corporate glow-up.
That's a good way to put it.
I mean, it's a company that managed to completely transform itself from, a legacy computing conglomerate into this high-flying integrated cloud software giant.
And it's a journey that spans decades.
So the subject of our deep dive today is Dayforce Inc. It's a name that might still feel a little new to some people, especially since they just rebranded from their much older identity, Ceridian.
Right. Ceridian is the name most people would probably still recognize.
Exactly. And our mission today is to really dig into that history. We're going to excavate all these layers of corporate splits, acquisitions, and these periods of private ownership that all led to this massive market-defining event just last year.
It is. I mean, it's a perfect case study in corporate transformation. What we're really tracking here is this incredibly complex evolution that goes back, believe it or not, nearly 70 years.
70?
Yeah, and it all culminates in the company becoming a leading American tech specialist in what's called human capital management, or HCM, software.
Okay, HCM, so we're talking HR, payroll, that kind of thing.
Exactly. And Dayforce Inc. is now, it's firmly entrenched in the tech sector. It's trading publicly as Day on both the New York Stock Exchange and the TSX. It even recently got a spot in the S&P 500.
Which is a huge signal of its importance to the market.
Right. It's a massive stamp of approval. It tells you it's a major player.
And the reason we're digging into this now and why it's such a compelling story of value creation is that headline event you just mentioned. Let's start with the payoff, the anchor point that really defines the success of this whole transformation.
Right. Let's start with the climax. It's the best way to frame the story. That moment arrived in August of 2025 with this just blockbuster announcement.
Okay.
The private equity powerhouse Thoma Bravo reached an agreement to acquire Dayforce, and the deal was valued at a staggering $12.3 billion.
$12.3 billion. I mean, that's not just a big number. For this specific sector, for HCM software, that is a landmark transaction.
It absolutely is, and you have to unpack that figure because it says a lot.
It really does. I mean, $12.3 billion for an HR platform tells me two things. First, the value of streamlining how you manage people has never been higher. And second, Dayforce must have achieved just, incredible global scale and technical integration to justify that price tag.
You've hit it on the head. And it wasn't just a standard buyout either. The sources highlight something really important. The deal included a significant minority investment from the Abu Dhabi Investment Authority, or ADIA.
Okay, now that is critical context. ADIA is one of the world's largest sovereign wealth funds.
Exactly. And they are known for seeking out these very long-term stable assets. They often look at them less like risky tech stocks and more like essential infrastructure.
Like toll roads or power plants.
Precisely. Things that generate steady, predictable cash flow.
So if you have a massive sovereign wealth fund partnering with a top-tier PE firm like Thoma Bravo on a tech deal, it suggests they see the subscription revenue from Dayforce as incredibly stable, almost recession-proof.
That's the bet they're making. Businesses have to pay their employees. They have to maintain compliance, regardless of what the broader economy is doing.
Right. It's a non-negotiable expense.
Exactly. So they're buying this recurring subscription revenue stream from software that handles mission-critical functions. And it's the ultimate validation that the whole strategy Ceridian and Dayforce executed over the past decade actually worked.
They built an asset so essential and so global that it attracts capital that's looking for stability, not just high-risk growth.
And that's the dream for a SaaS company.
So before we jump back in time, we really need to understand what Thoma Bravo actually bought for their $12.3 billion. The company's brand is Dayforce Inc., but Dayforce is also the name of the product.
Correct. And that's a very deliberate strategic move we can analyze, later merging the corporate identity with the platform identity. The core offering is the Dayforce Cloud Human Capital Management Platform.
And its unique selling proposition, the thing that makes it so valuable, is its architecture.
Right. That's the key. It's built as a full suite application. The goal is to consolidate all of these different people management functions into a single unified system.
Okay, and when you say full suite, we're talking about solving the biggest headaches a big multinational corporation faces.
Yes, all of them.
Okay.
The platform covers the entire employee life cycle and all the administrative burden that comes with it. This includes the really high-stakes stuff like, precise payroll processing and complicated tax filing.
The areas where if you make a mistake, it can cost you millions in fines.
Huge legal penalties and fines. But it goes way beyond just compliance. It covers benefits administration, general HR, complex workforce management.
Things like scheduling, timekeeping, making sure you're following local labor laws.
All of that. And then it goes into recruiting and even the more sophisticated area of talent intelligence, which involves performance tracking and predictive analytics.
So the pitch to a chief financial officer is actually pretty simple.
Yeah.
It's stop running 6 different aging systems, one for time, one for payroll, one for benefits, that you have to constantly, and with a lot of errors, reconcile.
Right.
Buy our one system, get rid of the integration headache, and lower your compliance risk.
That is the core technical value proposition. In the old world, a timekeeping system might dump a file to the payroll system once a night. If those two don't perfectly reconcile, you can introduce massive errors.
And that leads to compliance violations or huge overpayments.
All the time. So a truly unified single database architecture, which is what Dayforce claims to have, means that time and pay are always in sync. It dramatically reduces risk and administrative overhead. That technical superiority is what commands a premium.
That sets the stage perfectly. So $12.3 billion for a unified global people platform. But that platform has roots that go back nearly 70 years, back to the earliest, clunkiest days of corporate computing. Let's rewind the clock and see how this journey began.
It's a great place to start.
So to really understand the Dayforce of today, we have to look at its corporate lineage, which, as you mentioned, is really surprising. It didn't start in Silicon Valley. It started in the world of high-powered Cold War-era computing.
Yeah, this is where the story gets so compelling. Because this modern, sleek SaaS company actually descends from a technological ancestor that very few people would guess.
And that is
The Control Data Corporation, or CDC.
CDC, founded way back in 1957. Now, for listeners who might not be steeped in computing history, what kind of company was Control Data Corporation?
CDC was a true pioneer. They were one of the original giants. They were deeply involved in mainframes and, crucially, supercomputers.
We're talking massive machines that took up entire rooms.
Entire rooms, used by governments, universities, large institutions for incredibly complex calculations. They were a cornerstone of the burgeoning digital age, operating in a very capital-intensive world where manufacturing and physical assets were everything.
The journey from designing supercomputers in the 50s to selling cloud payroll software in the 2020s it's just an astounding strategic pivot. So what was the catalyst? What happened in 1992 that marked the official beginning of the company we're tracking?
Well, by 1992, the whole world of computing had changed dramatically. I mean, personal computing was on the rise, and the mainframe business was becoming a lot more complex, a lot less profitable.
The writing was on the wall.
It was. And the leadership at CDC made a really definitive strategic choice. They executed a major corporate restructuring to shift away from that legacy hardware business and focus entirely on information services.
And that move birthed the Ceridian Corporation.
That's the moment. Ceridian is born from the services side of CDC.
So this wasn't just a name change. This was a deliberate extraction of the most scalable parts of Control Data Corporation. So what happened to the actual computer manufacturing side of the business?
It was a very clean spin-off. The original capital-intensive computer product business was separated out and formed into a new company called Control Data Systems, or CDS, and they kept the legacy Control Data name.
While the new company, Ceridian, was intentionally structured to focus on data, on processing, on services, the intellectual property, not the physical machines.
Precisely. And this is a critical analysis point. This move in 1992, decades before anyone was even using the term SaaS, was an act of, genius.
It really was.
They recognized that the long-term value wasn't in the heavy, depreciating assets of hardware manufacturing. It was in the highly scalable, recurring revenue potential of information services and software.
Let's just contrast the economics there for a second. CDC needed billions in fixed capital for factories, for R&D on hardware, for maintenance.
Right. Whereas Ceridian, by contrast, needed recurring investment in intellectual property, in software code, data centers, and human talent. They were shedding capital intensity in favor of scalability.
That one choice, that foundational decision in 1992, paved the way for the Dayforce cloud strategy 20 years later. They were betting on services over steel.
A bet that obviously paid off. It really shows that corporate success often means shedding that heavy foundational past so you can be light enough to adapt to the future.
Ceridian inherited that service mindset, and it proved to be far more resilient than the hardware legacy it left behind.
And that service mindset eventually narrowed its focus onto the most complex and recurring service need that every single business faces, managing its people and their money.
Okay, let's transition now into what were some pretty turbulent years, because the company didn't just go straight from that 1992 restructuring to a big IPO. This next phase, from about 2001 to 2018, it's like a masterclass in corporate surgery.
It absolutely is. It's all about distilling a diversified company down to a pure-play, high-growth asset.
And this period is defined by these strategic separations and some really critical acquisitions. It was not a straight line at all.
No, far from it. The first major separation happens in March 2001. It's known as the Arbitron split.
Right, and can you explain the mechanics of that split? Because the names get swapped around in a kind of confusing way.
It's basically a swap to separate two very different businesses. The old Ceridian Corporation changed its name to Arbitron, and Arbitron focused on media and audience measurement services.
Like TV ratings and that sort of thing.
Exactly. The rest of the existing businesses, the parts that held the human resources services and also the Data Payments division, they took the Ceridian name. They were basically splitting their focus between measuring audiences and managing workforces.
So the HR services business kept that Ceridian brand and continued on its path.
Mm.
And then, just 6 years later, another major upheaval. Private equity comes knocking.
Yes, the private equity interlude of 2007. This is a huge moment. Ceridian was acquired for a very substantial US $5.3 billion.
Who are the buyers?
It was a consortium led by Thomas H. Lee Partners and Fidelity National Financial, or FNF.
Now, wait a minute. Going private in 2007 for $5.3 billion, right on the cusp of the global financial crisis.
Yeah.
Wasn't that a massive risk for the buyers? How did they manage to navigate that downturn while trying to restructure the company?
It was an incredibly risky time to do a leveraged buyout. But, the decision to take Ceridian private was actually the key. It allowed the new owners to undertake this significant long-term restructuring away from the quarter-to-quarter earnings pressures of the public market.
Right. When you're public, you can't really make these massive, risky internal bets without Wall Street punishing you.
Exactly. Going private gave them the capital and, more importantly, the breathing room to completely overhaul the company's technology stack.
And the immediate consequence, of course, was that Ceridian common stock stopped trading on the NYSE. It was officially delisted in November of 2007. They basically entered a strategist lab hidden from public view.
Right. The PE playbook was now in full effect. You buy the company, you strip out any non-core assets, you acquire new differentiating technology, and you invest aggressively for growth before, hopefully, taking it public again at a much higher valuation.
And the single most important action they took during this private phase was acquiring the technology that would eventually become the company's entire future identity.
That defining moment was in March 2012 when Ceridian acquired the Dayforce technology. This was the inflection point. The sources specifically call it a single sauce application designed for a whole range of HR functions.
Let's just emphasize that phrase again, single sauce application. Why was that so disruptive back in 2012?
Well, because the market was still highly fragmented. Most companies were running what we call best-of-breed systems.
So a specialized vendor for time and attendance, a completely different one for talent management, maybe a third one for payroll.
Exactly, and these systems rarely talk to each other well. It led to massive integration costs and huge data integrity problems. Dayforce came in and promised one unified cloud solution for everything: HR, payroll, tax, benefits, workforce management, talent, all built from the ground up on a single database.
It eliminated the data reconciliation nightmare for customers.
That was the promise, and it was a powerful one.
So the PE owners now had their core future asset. The next step in this corporate surgery was to make sure the corporate structure matched the high-growth potential of this new Dayforce SaaS product.
Which brings us to the final major separation in 2013, separating payments and HCM.
And this was crucial for maximizing the eventual valuation of the company.
Absolutely crucial. In October 2013, Ceridian announced the legal separation of its human capital management business from its payments business, which was called Data.
So why separate payments, Data, and the software, Dayforce? I mean, they're both in financial services, but they're valued very differently by the market, aren't they?
Drastically differently. This is pure financial engineering. The payments business, Data, it operates with the financial profile of a financial services or payments company. steady, but typically with lower valuation multiples.
Whereas the human capital management business, with Dayforce at its core.
That's a high-growth SaaS business. It commands much, much higher tech valuation multiples. So by separating them, the owners created Ceridian HCM Holding Inc., a pure-play software entity that could be valued very highly by tech investors, unburdened by the lower valuation of the payment segment.
That is the key. Every piece of surgery they performed, splitting off Arbitron, splitting off comm data, it was all designed to make the remaining HCM entity as attractive as possible to investors who are looking for that high multiple tech growth. It was all aimed at the biggest possible exit.
And tying this whole critical phase together is the leadership. We have to mention David Ossip. He's been chairman and CEO from 2013 all the way to the present.
So he was the anchor who guided the company through that post-split cleanup, the massive investment into the Dayforce platform, and then the eventual re-entry into the public markets.
That consistency of vision is so vital during a period of such intense restructuring.
And that successful distillation, that purification of the business, led directly to the company re-emerging from private ownership with a highly successful initial public offering, IPO, in April 2018.
And it was a massive success. It raised over $400 million, and it really demonstrated that the market was starved for a highly focused, integrated cloud HCM offering. The years under private equity ownership had done their job.
They streamlined the business, they focused the technology, and they set the stage for this aggressive global expansion as a public, pure-play tech stock.
And that's exactly what happened next.
So after the IPO, the growth trajectory just completely accelerated. Dayforce went on the offensive using its public capital to expand rapidly. Let's jump into the sheer scale of that operation and the highly targeted global acquisition strategy that followed. So we've arrived at the point where Ceridian HCM is fully focused, newly public, and just poised for global growth. Let's take a look at the financial footprint they achieved right before the final acquisition. We have the specific 2024 financial data from their annual report.
Right, looking at the 2024 financial snapshot gives us perfect insight into the strategy that would eventually attract Thoma Bravo. I mean, the company had achieved substantial scale. They were reporting revenue of US $1.76 billion.
$1.76 billion. That is a massive operational size.
It's huge. But the profitability metrics, they tell a very interesting story, one that's typical of this specific growth phase. So operating income was US $104 million, but net income was way lower at just $18.1 million.
Okay, so that's the crux of the Thoma Bravo thesis right there, isn't it? When a SaaS company has almost $1.8 billion in revenue, but these razor-thin profit margins, it signals one thing: massive, aggressive reinvestment.
That's exactly it. And that investment isn't just in general R&D. In the HCM world, it means continuous investment in local compliance and in integrating all these new acquisitions. Global payroll compliance is a very high fixed R&D cost.
So Thoma Bravo isn't buying a company that's maximized its profit yet. They're betting that once Dayforce captures enough global market share, they can flatten those heavy R&D costs, especially the cost of integrating new compliance rules, and just flip the switch on profitability.
And cause those margins to expand dramatically. That's the playbook. They're buying the infrastructure and the nearly 10,000 employees, 9,600 employees in 2024, to be precise, who manage this complex high revenue base.
And the balance sheet backs this up too. Total assets were over $9.12 billion. That indicates a very financially solid operation, which you'd need to support a platform running payroll all over the world.
Absolutely. But that global footprint, it wasn't built organically. It was assembled through a very strategic and rapid global expansion via acquisition spree.
And the strategy was clearly focused on one thing: buying local compliance knowledge and geographic scale.
This is a textbook M&A strategy for entering a highly localized service market like global HR. You can't just, translate your U.S. product into Spanish or French and call it a day.
No, you need to handle local labor awards, tax codes, regulatory filings, all of it. And the fastest, most effective way to gain that expertise is to acquire the best local player in that region.
So the spree began in 2019, right after the IPO, and they targeted the Asia-Pacific region first. They acquired a company called Retech.
Right. Retech was an Australia-based enterprise HR software company. And Australia has some of the most complex labor law structures in the world. They have these detailed awards that dictate pay rates based on specific hours and roles and conditions.
So acquiring RightTech gave Dayforce an immediate proven solution for that highly complex market. It was a crucial foothold in the APAC region.
A very important one. And they quickly ramped up that regional focus. The next year, in 2020, they acquired Ceridian Global Solutions, which was an Asian HCM provider. So this move broadened their reach beyond just the developed markets of Australia and New Zealand.
Significantly, Asia is an incredibly fragmented compliance environment. I mean, tax laws and labor rules shift rapidly from country to country, often with no central database to track it all. Excelity gave them the depth and regulatory expertise to operate across those complex, diverse Asian markets.
And the APAC consolidation didn't stop there. It continued aggressively into 2021 with the acquisition of Ascender HCM.
Right. And when you see 3 strategic acquisitions in one core geographic region, 2019, 2020, 2021, in such rapid succession, it tells you something.
It tells you that market saturation and platform unification in Asia Pacific was the #1 organizational priority.
They were trying to build a single, comprehensive regional product and basically buy out all the necessary specialized compliance libraries they would need to do it.
But their M&A map wasn't just limited to Asia. They simultaneously made a major move into a completely different part of the world in December 2021 by acquiring Atom Human Capital Management.
And this acquisition, which focused on Latin America and the Caribbean, is arguably the crown jewel of their compliance IP library.
Why is that?
Because Atom was a leading provider of payroll and HCM services, covering an astonishing 33 countries across Latin America, Brazil, and the Caribbean.
33 countries, each one with unique payroll, tax, and labor laws, all requiring constant legislative monitoring. I mean, integrating that level of specific, local compliance expertise into a single cloud application is exactly the kind of intellectual property a PE firm values at $12.3 billion.
It is a massive, expensive barrier to entry for any competitor.
Of course.
And that's the ultimate value proposition to a global corporate client. It's, you only have to deal with Dayforce, and we will manage the messy reality of 33 different jurisdictions, and we'll give you unified reporting and centralized data.
It moves Dayforce from just being a software vendor to being a de facto compliance partner for global operations.
That's the transition.
And the final major acquisition noted in our sources in January 2024 shows a slightly different strategic focus. It's a shift from geographic expansion to more of a vertical enhancement. They acquired a Denmark-based company called Illumi.
Right. Illumi was a highly strategic add-on. It wasn't just focused on compliance, but on the talent side of HCM learning and development, or L&D.
So training, performance reviews, things like that.
Exactly. It combined a learning management system, an LMS, and performance management into one integrated solution. So once they had secured the geographic coverage in APAC and Latin America, they started buying these highly specialized features to differentiate the platform even further.
And L&D, performance tracking, those are essential for talent retention, which is a critical concern for any CEO in the modern era.
It shows a real maturity in their M&A strategy. Phase 1, buy the geography and the necessary compliance. Phase 2, buy the functionality that makes the platform stickier and harder to replace, covering crucial areas like employee growth and development.
This comprehensive approach really confirmed their goal to become a truly integrated global people platform. And that strategic roadmap, from the focused 2018 IPO to rapid global M&A and nearly $1.8 billion in revenue, it leads us perfectly into the final act.
The identity shift and the massive sale. The culmination of the entire transformation.
So after years of building the Dayforce platform, the final strategic act was to unify the corporate identity with the successful product identity. They needed to shed all that historical baggage.
Exactly. And we see that in the high-profile rebranding that took place on February 1st, 2024. Ceridian officially transitioned the company's brand to Dayforce.
And this rebranding is so much more than just marketing, isn't it? It's a profound, symbolic, and strategic commitment.
It really is. They officially retired the Ceridian name, which carried all of that complex legacy from the CDC mainframe roots, the Arbitron split, the Comdata separation. By adopting the Dayforce name, they focused their entire brand equity on the one thing that had driven all their growth since 2012, the successful cloud platform.
And the public markets followed suit. The stock ticker symbols on both the NYSE and the TSX changed from the old CDA to the simple product-focused symbol DAY.
Which solidified their market positioning. They were no longer an HR services company that has a cloud product. They were the cloud product.
And this unified identity made them simpler to understand, simpler to value, and ultimately far more attractive to a tech-focused private equity investor like Thoma Bravo.
Which brings us right back to the climax of the story, the $12.3 billion conclusion announced in August 2025.
This is the ultimate validation, isn't it, for the strategy executed by David Ossip and his team over the previous 12 years.
Without a doubt. Thoma Bravo, a firm specializing in software buyouts and known for executing that flip-the-switch strategy we talked about, where they cut heavy growth investment to maximize profitability, they agreed to acquire Dayforce for that massive sum.
It's just essential to reflect on the full timeline, now that we have the whole picture. You have a company that's the descendant of Control Data Corporation from 1957. It goes private in 2007 for $5.3 billion.
Which was the necessary step to clean house and acquire the differentiating sauce technology.
Then they relaunch publicly after that cleanup, they expand globally, and less than 2 decades later, they're purchased again, going private for $12.3 billion.
That is just immense value creation within the dedicated HCM SA sector. It demonstrates not only the resilience of the corporate structure, but also the astronomical increase in the value placed on these scalable, integrated software solutions that promise to simplify the messy reality of global compliance.
And as we noted earlier, that partnership with the Abu Dhabi Investment Authority just reinforces that the value here is perceived stability.
They are buying recurring revenue streams from a platform that is now critical infrastructure for thousands of global businesses. It's a very smart, long-term asset acquisition.
They're buying stability, efficiency, and most importantly, a massive library of digitized, constantly updated global tax and labor law compliance rules, all packaged in a single application.
And that compliance IP, that intellectual property, is the core barrier to entry. That is the ultimate source of that $12.3 billion valuation.
So let's bring it all together. What does this all mean for someone trying to learn from this? Let's summarize the complex layers of transformation that created this tech giant.
Well, I think the story is a superb illustration of the power of strategic focus. You know, the company's origins in 1957 computing and that 1992 recognition that information services would beat physical hardware, that laid the groundwork.
But the real lesson is the ruthless self-purification that came after that.
That's right. The critical phase was definitely those middle years under private ownership, the multiple corporate splits, the absolutely essential Dayforce product acquisition in 2012, and then the final separation of payments and HCM in 2013 to get that pure play valuation status.
Without that intense, focused restructuring, the company never achieves the scale necessary for a $12.3 billion exit. It just doesn't happen.
And we have to reiterate the crucial role of sustained leadership. David Ossip provided that essential consistency, staying on as CEO through the transition from Ceridian HCM, through the aggressive M&A spree, and through the ultimate unification under the Dayforce brand.
And that strategy, post-IPO, was built entirely around global conquest, buying up local expertise in Australia, Asia, Latin America, Europe. But let's close on that truly provocative thought that we pulled from the source material about the future of a platform like this.
Right. Dayforce's phenomenal success and its massive valuation came from its aggressive focus on consolidating this highly fragmented global HR software market. They acquired local specialists to build what they hope is a single, comprehensive product.
And the sources, for instance, mentioned the Adam HCM acquisition, specifically covered payroll and services across 33 countries in Latin America, Brazil, and the Caribbean. That's an astonishing amount of varied regulatory complexity.
And this raises the biggest question of all for the future of global business software. It's the wager that Thoma Bravo and ADI just made with $12.3 billion.
And that is.
Can a unified single application SaaS platform ever truly standardize and perfectly manage the massively complex and varied compliance requirements of 33 or 40 or 50 different countries into one neat, seamless package?
Or is the true value just in the promise of simplification, that single source of truth, even if the underlying regulatory reality remains chaotic? I mean, the $12.3 billion valuation suggests that the market believes the compliance IP developed and acquired by Dayforce is a sustainable, highly defensible moat against any competitor.
It's a fascinating narrative of corporate survival, strategic betting, and the immense value we now place on technological solutions that promise to simplify global administrative chaos. From mainframes to the cloud, Dayforce has shown how corporate identity can, and often must, evolved to align with its greatest source of customer value.
An incredibly complex journey distilled down to the essential lessons in business strategy and value creation. A fantastic deep dive into the evolution of Dayforce.
My pleasure.
And thank you for joining us on the deep dive. We'll see you next time.